Hello, Ray. This is Jake Stenziano, host of the Jake and Gino podcast. Here with my co-host, the multifamily mentor, the coach, the chef, the father, six, the best-selling author, the G-Daddy, Gino Barbaro. Gino, how's it going?
Jake, I'm doing good. I got my Peter Millar shirt on just for
Are
you
they paying
today.
You for that?
They're not yet.
Okay.
You got to work it a little bit. You got to get on. Make sure you have a lot of people see it. I love the colors here. Big shout out to Peter Millar. Jake, how you doing?
Gino's literally wearing art these days. I don't know where he's gone. The humble man is lost his folks. So, hey, we're always making it happen. Today's guest is the creator of AcquisitionLab and best-selling author of Buy, Then Build. I think this is going to be very appropriate for the multifamily game. He has practiced acquisition entrepreneurship since 2006 and has since amassed $16.5 million in revenue. So, without further ado, Walker Deibel, welcome to the show.
Jake and Gino, thank you so much for having me on. I don't know who Peter Millar is, but I'm loving the shirt, Gino. The colors are just vibrant, and it's just what I needed this morning. Thank you.
2 for 2, Jake. See that, brother?
If you don't know, now you know. So, Walker, let's get to know each other a little bit. Please share with us your background and how you got your start in business.
Sure. So, it's one of these things where let's go back to when I was getting my MBA, right, at the Olin School of Business. And I sort of used that pause in my resume to see if I could be a successful entrepreneur, right? And I really went for it. And I had multiple attempts at trying to start a business. And what I discovered over time is that starting a business from scratch is kind of punishment for not understanding statistics, right? Like they don't succeed by and large. And we all know it, but we sort of have these Han Solo moments and it's like, don't tell me the odds. Let me.
What are the odds?
This. I mean, Jake, do we really know? The thing is it's
They're not good, is what you're.
It's sort of an axiom that it's like, or a maxim that maybe 10% make it, like 9 out of 10 fail. But the thing is that if you talk to entrepreneurs, a lot of us believe that the odds are not that good. They think it's less. And when you look at Vern Harnish's work, you understand that the people that actually make it, only 4% of them ever exceed $1 million in revenue. So even if you succeed as an entrepreneur, the odds of you staying, very low to the ground are extremely high, right?
Can I touch on this for a second? Because you brought up such a good point. And oh man, there's a quote that Ray Dalio uses to describe himself. And I forget what the actual term is that he talks about himself this way. And he also talks about Steve Jobs. And essentially what he says is it's because he is a visionary, but he can also manage team members. And he said it's such a rare bird that's able to do that. So when you're talking about these startups not making it, it's because they're so heavily reliant on the visionary, on the person that's forming it, but then they fail to scale. And that usually is where the person is not able to go from the solopreneur to the actual enterprise. And that's that huge gap. And that's why you mentioned Vern there. He has such a great business because he helps folks get there. But usually it's because they need to replace themselves. So sorry, I'm just having fireworks going off because I've lived this. And you brought up a fantastic point.
Well, and let me interject, Jake. I think you're on the right track. But I also think that your commentary there is also kind of isolating the major leagues, right? And there's this sort of AAA up to the major leagues. And so the truth is it's less than 0.5% of companies ever exceed $5 million in annual revenue.
Wow.
So when we're talking about, Steve Jobs, and, all the other people that have publicly traded companies that are actually profitable, right? It's sort of a different game altogether. And I think going from that $3 to $5 million, black hole, is one of the hardest things that we experience as entrepreneurs, right? So like they always say, going from zero to the first million is the hardest. But I got to say, I know this isn't the topic of this podcast, but like I think that like that 3 to 5 range, if you get stuck in there, you're kind of in
my
no
ego,
land.
Baby. You're making me feel like a hero right now. Keep it coming.
Yeah,
I'm loving what you're saying.
Yeah. So getting that first million under your belt, you're securing product market fit, right? You're securing infrastructure that's needed. Usually, if you're buying businesses like I do, there's positive earnings on the bottom. They're bankable assets, right? So it's one of these things where you get it's sort of, I call it the Moneyball of entrepreneurship. You sort of get all of the important things right, and then acquire it and lead it from there.
Jake, I'll answer your question about the startups and what the percentages are in the book. Buy Then Build, which everyone should run out and buy. Startups are about 10%. success. VC backed are 25%, and AC entrepreneur are 98%. And the next question I'd love to ask, Walker, is what is an acquisition entrepreneur? How would you define that?
Yeah. So, it's one of these where coming out of business school in 2004, I thought to myself, like, okay, when I walk around, Washington University is in St. Louis, and when I walk around, Wydown Boulevard and look at all the biggest houses in St. Louis, this was turn of the millennium. Like, these are not Silicon Valley entrepreneurs, right?
They're car dealers.
Yeah, they live in these like 8,000 square feet homes in the biggest boulevard. People who live in Ladue, Missouri, one of the top 10 richest neighborhoods in all of the country, they're not tech entrepreneurs. So it's sort of like, what are all these people doing? And Jake, to your point, it's almost like they own like 6 subways or something like that.
Yes.
You know what I mean? It's like it's very they're very sleepy, unsexy businesses that do not make headlines. They're not on the front page of Inc. magazine or anything else. And I started to realize, like, wait a minute, it's this profitable infrastructure that these businesses have. And so how, like, I know there's a way to kind of, buy these companies, right? And so how do I do it? And so when I was writing Buy Then Build, I spent 4.5 years writing it, and I was sort of like coming up with all these ideas around how to frame it. And, we think about, like tech entrepreneurs, we think of real estate entrepreneurs, we think of, internet entrepreneurs. And I just thought to myself, acquisition entrepreneurs. And the point is that I would hang out with a lot of entrepreneurs, and they would always say, like, oh, this is Walker, he buys and sells companies. And although it sounded kind of dope, it also sounded very like...
Great pickup line.
I was kind of like a finance guy that wasn't really an entrepreneur. And I felt like as startup entrepreneurs were sort of pigeonholing me in that way, they were missing the point, which is that acquisition is just as effective and just as important as innovation. However, it's not any easier. You're still in the field. You still have dirt on your face. You still have blood on your hands, or maybe I got those backwards. But it's still a full contact sport, and it's entrepreneurship at its core.
I love the quote in the book that, Jake, this is the bane of our existence for the last 5 years. Buy for the future, pay for the past. Can you dive into that? Because we haven't been able to do that. We're buying for the future and we're paying for the future. And it's so freaking annoying. It's like, dude, would you raise interest rates and let some sense come back?
Gino, over my head. You lost me. Tell me the quote again.
You've been looking at the shirt. That's why. Focus on me, brother.
I'm mesmerized. No, I'm looking at the shirt and I'm just like, how much did that thing cost? I want to know if I can afford it. Like, is that an acquisition or do I have to make it myself? I don't know.
Thanks for the future.
It's more than a little and less than too much. That's what the price was. Anyway.
No, but tell me the quote. Okay. All right. Here we go.
Buy for the future and pay for the past. That's just like the bane of our existence.
Buy on actuals.
Yeah, that's probably Walker's smarter than Jake and Gino, so Walker makes it more eloquent.
I got to keep it.
I'm not, but let me. So here's how you need to think about business valuation. All right, there's ultimately at its core 2 ways to think about running the valuation of a business. All right, and the first is let's go back to these VC raised startup kind of businesses. The truth is they don't have product market fit. They usually have very minimal infrastructure. And what they're doing is they're saying, look, here's our idea. Here's the market. Here's our special sauce. I'm the guy. This is the team. We are going to go do this thing. And with your money invested in our company, we can build this infrastructure and we're going to sell it in 3 to 5 years for $100 million. And I can sell it to you today at a deeply discounted valuation of 50, because I need your cash to go build this massive thing, and you're going to have sick profits. That's a future-looking oriented valuation, okay? Now, when that business gets built, and now let's say it's doing, pick a number, $3 million in revenue, okay? And they say, okay, I'm the owner. I own 100% of the equity, and I'm going to sell this whole thing to you, and then you're going to take over, and I'm going to bounce, all right? I'll see you later. You guys, good luck, right? There's no team anymore. There's no entrepreneur. 100% of the ownership is leaving. Usually in these small businesses, it's the owner that's the one doing the heavy lifting, right? Mm-hmm. And even if they're not, the point is that it's now a historical based valuation, okay? So when you are buying a company, what I always emphasize is look at the historical performance of the business, because that's going to be the anchor of the valuation in which you are driving. Now, a great. I heard.
Explain anchor for folks, because I think that means different things to different people.
The primary drivers of business valuation are growth and earnings, period. Historical growth and what are the earnings, right? And what the earnings are, there's different ways to tell time. Again, slightly different podcast, but you can look at sellers' discretionary earnings. You can look at adjusted EBITDA. You can look at EBITDA. They're all very different numbers. People like to just throw that out. In real estate, I think it's NOI, right? But it's one of these where you look at what the earnings are, and you look at what the growth has been leading up to that, right? And so if you have a business that is generating, 7 figures in adjusted EBITDA, and you're experiencing north of 20% year over year growth for 4 years in a row, you are one of the fastest growing, biggest company, most successful companies in the history of the world.
We're
What?
partying. Now we're partying. That's internally, that's what we shoot for, 20% year over year growth. And it's very simple. You stick that number and you work towards it. So I love that.
Yeah.
The reason I asked you about the anchor is because I think you attempt to anchor to that acquisition model in terms of you don't want to pay for the future. You want to pay based on actual. So if you can anchor to what you're currently doing, that's good for the buyer. That's what I was getting at. And from a negotiation perspective, that anchor is important because you can say, look, this is what you're doing, especially to your point. If you're piecing out, I got to take this over. I'm buying based on what it's worth today. The future is mine.
I know you guys are multifamily entrepreneurs. So my question for you is the way that I've put my toe in your world, right? And that's it. But what I see is a lot of buildings, and they'll be like, hey, here's, pick a number, 16 units. And guess what? 5 of them aren't rented, and the other ones in here are below market rent. So all you need to do is come in and increase the rent on the people that are in here and fill these units, and look at all the money you're going to make right away. My assumption is they need to be pricing off of current realization and not what the work that you're going to do, right? So, that's the right answer, but of course they're going to show you this forecast and say, like, look at all this money you're going to make. Like, you just have to do these little things.
So, Walker, the problem is it's called the market cycle, and it's called really the cost of capital, whereas there's a lot of demand for that asset. So when we started back in 2010, there wasn't a lot. You couldn't sell on the future, painting that picture. You're selling on, please take this problem away from me. And we're getting back to that right now. And I think the last couple of years has been very hard. We call it our buy right criteria. Set up a criteria for yourself. See how you're looking at these assets and seeing where you can add the value. And that's been the problem for the last couple of years. And the markets continue to cycle when the cost of capital tends to go up, and all of a sudden the recession's coming on. You're going to see it in your business world as well. All of a sudden prices start to adjust. When things get more expensive, when private equity can borrow at 1% and 2%, they'll buy anything overpriced with the dream to try to sell it to the next person. That's starting to stop right now. And that's really good for us in our business, because we're able to go out there and actually acquire stuff based on actuals. You're basically buying on a pro forma. You're buying on your pro forma, but you're trying to buy on actuals with the pro forma 12 or 18 months out.
Yeah, and Walker, we're long-term investors as well, so we hold all of our assets. So, to Gino's point, 10 years ago, we'll just say, we were buying things that were just killer deals. And then when the rent goes up, it's like, oh my God, these things are so amazing. And then the last couple of years, it got really frothy. What kept us growing over the last few years is that we were established. People knew we could close. And so we would have existing relationships with brokers or sellers, and we would buy their assets at a more reasonable price because of our track record and reputation. But I think it was harder the last few years if you were trying to step into the business. Now we're getting deals that, wow, we're like, these things are just absolutely killer because the market has contracted a little bit and people are afraid and want to get out before they think it collapses again or something like that. So to Gino's point, he nailed it with the market cycle. And then also for us, to his point about the debt, we may be paying a little bit more expensive when it comes to our debt right now, right? But ultimately, if that even ticks down, because we're getting quotes from agency that are like in the high 4s right now. But if that goes to the low 4s, historically we crush in that area, mid to low 4s. So if we even say we got to do a community bank deal right now where we're at like 6%, but we can get that out to agency in a couple of years at 4.5, and we got our price, we're killing it. So it's all about the market cycle, especially when you're talking about multifamily. And I just want to piggyback on one more thing, because you were saying, well, I looked at multifamily and I kind of dipped my toe in. That's the problem right there with it, because if you just dip your toe in, you're getting those frothy bullshit deals that no one really wants to touch because you're not entrenched for the long term. And then when you commit to it and you really ride into the multifamily game for the permanence, that's when things start to present themselves. It's when you kind of flirt with it where it doesn't work super well.
So many analogies in what you guys just said. That's really intelligent. Like, in the market cycle is just so interesting. Just to loop it back around and land it. The thing is that when I get a pro forma from a seller, I don't wipe my backside with it because it's an insult to my backside.
Oh, no baby wipes for him.
That's the point, right? You pay for the past, everything we're sort of talking about, and you buy it for the future because of what you're going to do with it. And you guys are acknowledging the market cycle right now, right? And you're saying like, hey, we can change these things in a couple of years, and we're going to rock.
I think we can also discuss what we have called the 3 pillars of real estate. And for us, it's our proprietary framework where it's all out there. But if you pull it all together with buy, manage, and finance, it is market cycle, it's debt, and it's exit strategy. And I think you'll appreciate the quote. You don't make money in real estate on the buy. Everyone thinks you make money on the buy. You make money on the exit. You make money when you either refinance the deal or you sell the deal. Now, you're making cash flow monthly. We like the distributions, but you may make maybe 7 or 8 or 10% on the cash flow. But when you refi or sell, you're making in excess of 100%. So I think people have to understand that where you are in the market cycle, what your exit strategy is, and that will allow you to understand the type of debt that you need, whether it's shorter term bridge, you can get some owner financing, whether you want longer term fixed rate. If you put all 3 of those together, and even when you value a business and you're talking about buying a business, I think people should look at it from that lens as well.
Gino is smiling because at the Acquisition Lab, that's what I always say. Like, look, you guys, you've been hearing way too much about real estate. Everyone says you make money when you buy. I need you to throw that out the window. You guys are paying like, 2.5, 3.5, maybe 4.5 times, annual earnings here, right? Like, it's not going to matter. Like, you compare it to a publicly traded company where they're trading at 19 times or sometimes 28 times or whatever. It's just, like, yes, the market's thin, and I understand that, there's risk in this game. But I think you guys would agree the risk is not in the property. The risk is not in the business you're buying. The risk is in the entrepreneur that's doing the buying and running the asset after acquisition.
You know where it gets even riskier? When it's a straight syndicator who is not engaged as an operator and is putting the deal together. That's where I see the supreme risk. So you have a money guy that's not going to be getting in the weeds and making sure he's managing the manager. That's where the supreme risk lies, especially in the multifamily game.
Wow. So that'd be like limited partners making multifamily investments?
Well, they're the limited partners, but the general partners who are the ones going out there and raising the capital, if they're not what we call vertically integrated, they're not the ones who are actually running the deal. Yeah. I mean, they should actually be managing. So there's property management and there's asset management. The property management is managing the property, right? And we're vertically integrated, so we manage our own properties. But these syndicators should at least be on the asset management side. Like you're saying, Jake and Gino, we say we create multifamily entrepreneurs. Those multifamily entrepreneurs are the asset managers. They're not buying a piece of land or a piece of real estate. They should be managing the asset and managing the property management company and doing budgets and actually creating the business plan, not just raising the money and going, okay, we got third party, we're going to wipe our hands. It's buy right, manage right, and finance right. And I think most people forget about that because it's not sexy to talk about.
That's where the risk is. That's all I'm saying. You get somebody that's good at raising money but doesn't. It's like raising a kid. They don't tend to the child. And then the child ends up being a druggy delinquent, and people are saying, "What happened here? You this deal look great on paper. Well, you didn't raise the kid. You got to spend time with it." So,
tell me about your childhood, Jake.
my dad played catch with me every day. That's why I'm crushing it. All right, true story. Cannon rocket arm here. I'm telling you. Let that sucker rip.
Walker, in the book, I like it because you have the opportunity, evaluation, analysis, and execution. Those 4 stages. You want to run through those real quick and get people a sense of what your model looks like and how they can actually start looking at deals and maybe end up closing on those deals.
So it all comes back to where the risk lies, right? And I think that when you're buying in real estate, for example, there's a certain skill set, skill and ability that you're bringing to the table, right? You just shared that you guys are getting more deals because you've been around, you built the skill set, you've got a reputation, all the things. You're bringing something to the table when you buy a business, right? When you guys buy an asset. when entrepreneurs buy a business, a lot of times I don't have good data, but it shows that the data I do have shows that 90% of people that head out to try to buy a business never actually buy one. Okay, and this is from business brokers, etc.
Wow.
And the truth is that I think it's because the brokers are thinking about it incorrectly, and I think that the buyers definitely are thinking about it wrong, right? And they're all first time buyers, right? Obviously, at this stage, brokers tend to say like, okay, well, what'd you do in your past? Like, what's your background? What's your resume look like? And then they basically say like, okay, this guy was in, healthcare. Let's go buy him a healthcare business. And it's like, well, that doesn't mean anything, right? So in other words, it's all about the risk is in the entrepreneur, not the asset, right? Because the same business under two different people is either going to perform or flounder, right?
Mhm.
And so for me, it's all about starting with the individual, understanding what are the skills that you bring to the table. What's your aptitude? Okay. I want to understand what is it that you want to do with your time. Okay. If you love, racing road bikes, owning a bike shop probably sucks because when the weather's beautiful and everyone's riding bikes, you're in fixing other people's bikes as a
This is so
mechanic.
good.
Right. So the point is like, you got to figure out what you bring to the table. Once you buy that business, you are now the owner and CEO on day one. Okay. You've got to figure that part out. And in my experience, once you figure out what you're good at, it's not about what industry the business is in. It's the opportunity that the business is providing to you. Okay. So you might find it. Look, if you're great at sales, like direct sales and sales management, what you need is a business that has, operations handled, a great product, and is just in need of, direct sales and scalability. If you're an operator, okay, maybe you want something that's a little tired. Maybe you want something that already has salespeople in place that you can just grind on, right? And you're going to get in and, maybe roll some heads and increase the bottom line of that business, right? So, and of course, there's like 24 different variants of that. But so as you figure out what you're good at, what you bring to the table, then the business will usually provide to you the opportunity that is there. And that's really what you're looking for. And I think that the industry and even the size of the business are secondary to getting that part right.
This is so important, and it's one of the smartest things I've ever heard on the show, Gino. It's because the Steve Jobs quote. I always go back to this: "Do what you love, and you'll never work a day in your life." I don't know if people misinterpret that or he was just flat out wrong. And I love Steve Jobs, but it's the same thing that happened to me. I got out of college. I love playing sports, so I went to be a personal trainer, and I was the most miserable I was ever in my entire life. Everyone's, Jake, I don't want to do this. Why are you making me work so hard? Blah, 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 blah. I'm like, shut up and do the push-ups. Right? No, I was like, I was ready to kill somebody. I'm like, what am I doing here? It made me hate the gym. So all these people are like, to your point, I love riding bikes, so I'm going to go start a bike shop. Or I've like heard Gary Vee talk about Pokemon, start being a Pokemon trader. That is absolutely incorrect. And I've said this before also on the show. I don't have this huge passion for real estate, but we're damn good operators, and that's why it works well. And that's why I love it, because we're successful and it creates a great vehicle for our families. I can lean into it. The success brings me joy, not the vehicle. Guys, so many people are missing that. I cannot stress this enough. If you're in healthcare right now and you're a doctor, it doesn't mean you need to go out and open up medical practices. Maybe you're good at that. You can run these things, but such a solid point, man. I cannot stress that enough.
How do you really feel, Jake?
Passionate about what he just said. I think it's a very sound point that people need to hear.
Yeah, and I think that when people first go out to try to buy a business, where their brain is wrong, and that the way that they're looking at it is incorrect. They go into analysis paralysis, and they're trying to comb numbers, and they're trying to de-risk the acquisition by squeezing out the P&L. You know what I mean? And like they're looking for. Look, at the end of the day, you need to find a business that fits your skill set. Number two, you need to understand. Can I cuss on the show?
Please. Skill set over passion. I want to say that. That's what he's saying. Yeah.
Number two, you need to understand that this is going to be fucking hard. Okay, like when you get in there. And number three, you need to understand what the risks are, right? And then you need to say, okay, I've identified the risks. I feel like I've identified all the risks, and I'm comfortable that I can navigate them, knowing that this is like my job, right? Mm-hmm. And there's nothing that makes me cringe more than when I see, private equity folks say things like, "Oh man, this business is just like kicking off like 3 million. Like this is great." And I'm like, nothing's kicking off anything. Like there is a grind happening, and there's nothing passive about what you're about to do, right? So, and every time I see that kind of attitude, those people tend to call me a year later and say like, "Dude, help." And I'm like, it's hard. You can do this, but you got to get in there and you got to make it work.
Bro, it's just kicking cash, bro.
Now there are business, like, I've got the AE matrix in the book. Like there's different assets, right? And like you can say like, hey, I just want something that's a little safer, that's not going to have as much upside growth, or you can take on more risk and say like, look, I'm an entrepreneur, I want something I can grow, right? And there's different models that different approaches you can take.
Walker, before you go to the short answers, you wrote an article about 5 things you need to do before selling your business. I think this would be appropriate for multifamily investors as well, getting their business or their property ready to sell. Can you dive into that for us?
Gino, I'd love to. I have no recollection of writing that article. It was probably a couple years ago. Can you remind me?
I don't remember what it was. I just saw like, hey, this would be great.
Okay.
As far as like getting a business prepared to sell, what do you need to do? Because most people, I know the first thing is solicit the broker and get your P&L ready. I mean, that's it. And it's not like a 3-month thing. You need a runway to get your business ready.
Yeah. Okay. So let's do this. I also have a lot of experience as a broker. Okay, I sell mostly online-based businesses. I partnered with Quiet Likes after 10 years of buying companies. I just got really good at it and reached out to them. And so I've helped probably just shy of 100 million in people exiting, and I work one-on-one with sellers in that fashion. Here's just at a high level, if I were to boil all of it down into just like a few things. Okay. As we've covered, it's growth and earnings, right? Then it's going to be growth opportunities. Okay. So in other words, buyers are not stupid. They're like us. They know when all the meat has been eaten off the bone, right? You got to leave something there for someone else. Not you can't like sell it to a vulture.
Not in 2022.
Touche. Then it's business risks. You need to identify and minimize the business risks. Then you need documentation. Okay, so obviously, please have strong internal financial statements. Like all those types of things, standard operating procedures, all of that stuff. And whenever anyone has any questions, you've got to be able to produce documentation. And then number 4 is it's going to be transferability of the business. So in other words, if you're buying a solar company, just for example, a solar installation company, and the seller of the business has a master's degree in solar engineering from one of the 2 schools globally that has that program, and that individual is the owner of the business who is also doing 100% of the sales and 100% of the design work, that business is not transferable, because once that person leaves, there's no sales, there's no engineering, right? And so you need to, when you're growing a business, you need to put your back into it, right, guys? You need to get involved. You need to get in the arena and grow it. And then once you've scaled up to that level that business can achieve, or you want to get it to, then you need to start engineering your exit so that you're working 20 hours a week or less, and all of the main tasks are being operated by other people. Now, are you giving up earnings when you do that? Yes. But you're engineering transferability into your business, and you're minimizing risks, which usually will sell for a higher multiple of earnings as opposed to a lower multiple and transferability risk to a buyer.
Jake, before we go to the short answers, that second one that Walker talked about, the opportunities, you're at a high in the market cycle when you hear opportunities in multifamily that say material value add or substantial value add. You're basically buying crap, and you're just
how
making
many different bolt-ons did they have for the term value add last year? It was light value add. It was materially found bullshit value add. Like there was 6. It was like Barbie's different toys, right? They were good. A different name for every value add, like so many different ways. It's crazy.
Yeah. I love that.
Look, I love you guys. It's great.
All right, guys, let's take a quick time out to hear from our sponsor.
Join Jake and Gino on May 23rd at 8 p.m. as they discuss the top 3 pitfalls to avoid in multifamily property management. With over $260 million in assets under management, Jake and Gino are the leading experts on investing and managing in the multifamily space. Don't miss the opportunity to learn from 2 of the premier leaders in multifamily. Go to jakeandgino.com/webinar to register today.
All right, we're back. You really got me interested a few minutes ago because we're vertically integrated. We have our holding companies that own our properties. We have our property management company. We have our education company. And we also have a whole life insurance company as well. So we love these bolt-ons that are synergistic with our core, which is the real estate company. We deal with multifamily brokers. We have wholesalers that come to us. We know the multifamily space, so it's just at this point it's second nature to us. But you said that there's people going in to buy businesses, and that's a whole new world for me. I've never gone out and said, "Hey, I want to buy a business." We always started ours from the ground up and grew them off our course. So just explain that. Say again, Gino.
We weren't too smart. We probably should have acquired.
We work too hard, right? We work way too hard. So now I'm like, I want to hang out with Walker now and have some beers with him and find out this world. Because just explain the world a little bit more in depth of what it looks like to buy businesses. Because I think you said you're a broker. Is that correct? You sell businesses to people? Okay, cool.
I do. So I think of my life as three legs of the same stool: businesses I own that I've acquired, helping sellers exit via Quiet Light, and then also AcquisitionLab, where we work with potential first-time buyers to get smart and close on that business. Yeah.
So, we'll go and, the brokers will basically send us deals. So we need to know the brokers that operate in our kind of geography, right? So that will kind of create, because there's not a realtor.com. I mean, there's sites where people post the multifamily deals, but if you really want to see the deal flow, you need to know the brokers, and then they'll send you the deals and you create your own ecosphere, right?
Yep.
So
that's
for your world, I'd be interested to network with you and some other folks, because there may be bolt-on opportunities for our business that have synergies that we can bring in. So this just opens, my eyes to a whole new world, right? Like I've been stuck in my little multifamily cave here with our little bolt-on strategies.
Oh, new world.
Yeah, I want to like step out of the igloo and say, well, hey, what you doing over there, Walker? What you got? What you got something to bring on over to me? Like, so I don't know, maybe explain that. And for a group like ourselves, any ideas or what are you thinking? Ways to find synergies there?
Yeah, a couple ideas. So the first thing I would say is that, again, there's this myth that is circulated in first-time business buyers that they shouldn't go to brokers, that they really should, try to generate, their own private deal flow and reach out to CPAs and business owners and all.
I'm not prude. I want to work with you. Let's jump in the sack.
Yeah. But the thing is I'm with you guys. I think that the brokers are the ones that actually have sellers that are ready to go and they're organized. Okay. And so you are typically lopping off 2 years of time if you just go directly to the brokers, because that's where the sellers are going. Right. And so that's step number one. So in other words, I'm validating what you said. Like, stop reaching out to all these private business owners. Go directly to the brokers. And number two, I think about growing through acquisition the same exact way that I think about buying a business for the first time. In other words, when you look at, I'm sorry, I don't have the numbers in front of me, but I recently did a talk about the sheer volume of businesses that the most innovative companies of our time have acquired. If you look at Microsoft, Apple, Facebook, I mean, the number, each one of those companies has acquired more businesses than BlackRock. Okay. Buffett, right? No kidding. So the point is that you need to embrace acquisition along with innovation. It's not necessarily a substitute. It can be a substitute at any given time.
I'm getting too old for innovation.
Yeah, Jake, my favorite members of the AcquisitionLab are the ones that are like, I started a business, I exit it, and I am not doing that startup part again. Like, I'm going to buy the first million.
I've been there. All right.
Right?
I've had my time with that. It was great, but we moved on from that. Right?
Moved on. Right. So
but Walker, I'm sorry. Part of the problem is nowadays you've got to build a brand, and that takes time. And marketing is so important. And if you've never done it before, I mean, for instance, our 100-year real estate investor, we've got a 100-year brand. It's taken 2 years to get out there. And people want to wait 2 years. And that's very difficult to do that. There's a lot of opportunity costs where you bought a deal or built a building with cash flow day one. You can expand upon that. And that's a really hard thing for people because we're all looking for deals. Jake is a cheapo. I'm a cheapo. We want deals. We want to do it ourselves. We want to bootstrap. But at the end of the day,
you're not helping us here with the broker. All right. He doesn't want to buy. He doesn't want to sell cheapos. All right. We pay top dollar, bro. We're like $20. All right.
I have so many value add opportunities for you guys. I got this kind,
As
that
long,
kind. So
as long as they're material, as long as the
yeah,
material value adds, I'm in, bro.
here's the thing. I think that we all want to fast forward. Like, how do I get to that first deal, right? But as you guys have experienced, you can't necessarily fast forward from like, hey, I'm just getting started to now we have a reputation, right? And as badly as people want it, I sort of say like, look, the people like I've got so much data, and it's like the people that are actually closing on deals, they're looking at 60, 70, 80 deals before they buy one. They're not like sitting around looking at one a week being like, well, I can't find any deal flow. It's like you don't need deal flow. You need one good deal that you're going to capitalize on, right? You need to move. So you have to understand that you're going to do it, right? And being in my broker role, I can just tell you most people aren't actually going to do it, and they're big time wasters. And so you need to get confident on the business model. You need to understand how the opportunity works, and then you need to get, frankly, aggressive, and you need to be that squeaky wheel with the brokers. Now, if you understand your core competency, then you, as your business, then you already understand what it is you bring to the table, right? And if you go out and say, look, this is exactly what I'm looking for, the more specific you can get, the more traction you're going to get with the brokers, right? And there's a lot of brokers that work in very specific parts, very specific industries, very specific things. And those are the people you want to work with. As of today, I'm going to tell you, you can, I can help people shave off, a lot of time, right? And it's hard to quantify, but I would say I can help them shave off about 6 to 18 months of their search just going through the acquisition lab and getting straight on what we're doing. Okay.
Most people quit in that 16-month period. That's why that's huge.
That's right. I did the first time, but there was back in 2004, there was no word for like searching for a business. Like my mother-in-law was like, "What are you doing?"
I
like,
don't know where to go to buy it, right? And I'm a business person with a shit ton of employees. I don't know how to go buy a business right now.
Yeah,
I can buy a multifamily business.
Yeah, right. So the lab is something that would be great for you, Jake. But the thing is that, and I don't mean to be selling you on anything. There's a bunch of free stuff on Buy Then Build. But this is why I built it, right? Is like I got 12 calls last week from people like, "Oh, hey, I want to buy a business. Can we have coffee?" Or like, "Hey, I've got this deal. Will you sit down with me?" And I'm like, I can't, like I have to go to work. I can't sit around and do free consulting all day. How do I engineer a world-class program to help people work through this? And that's what the lab is, right? So the second thing though is that I can't share with you how we are building a faster way to integrate buyers like you with those brokers, because it's not built yet and it's not released yet at the lab, but we're currently working on it right now.
Nice.
So a little teaser, but I can't. Yeah.
Jake, let me just interject. Let me interject real quick. As we're talking about the buy then build, we haven't talked about the financing. You got to read the book because there's a lot of stuff with SBA loans, and because people are saying, "How do I get the money?" He's got some great strategies in here. Walker does about acquiring these businesses. I mean, there's similarities. It's so amazing because Walker's talking about looking at 60, 70 deals. Well, in multifamily, you're underwriting 80 to 100 deals for that one deal. Very similar as to what you're doing. And the same thing with financing. Well, we have seller financing and master lease options, and there are other ways, creative ways, which, by the way, as we get into a recession, are going to become much more prevalent. So don't think yourself saying, "I don't have the money." That's not the problem. What you need is the hunger, you need the passion, and I think you need the ideas. That's what Steve Jobs had. That's what all these entrepreneurs have, is they have ideas, and then the money, you will find the money if you have those three mentioned above.
That's right. I think look, in January 1st, that was a holiday, January 2nd of 2016, okay? The SBA came out and basically said, look, we're going to allow buyers to put 10% down on the transactions, okay? And we're gonna cover 90%. We're gonna give them 90%. And the SBA isn't actually giving the loan. It's a bank that's an SBA lender, and the SBA is being the collateral. You need to sign a personal guarantee. And I think that a lot of entrepreneurs don't want to do that. And it's like, that's fine. But you understand when you're raising money and taking someone else's money for your equity, what are you doing? In my opinion, you're making a promise you're going to give them their fucking money back, right? Mm-hmm. So like, as soon as I ask you to sign a personal guarantee and you don't want to do it, how does that make me feel? Like you're getting 100% of the equity, okay?
Or 10% down?
10% down.
I'll take some of that.
I bought 7 companies exactly in that model. Right. I mean, like it crept up to about 18 as my portfolio got bigger. So I was putting like 18% down. But the same thing that you guys are talking about, deal structures are seller financing, earnouts, uh, well, there's multiple different kinds of earnouts. There's cash at closing. There's bank financing. There's investors. I mean, there's all kinds of stuff you can do.
Mm-hmm.
The one thing
I'm
that I would
juiced right
say,
now, guys. I want to go buy some.
well,
I don't know
the
what
one
it
thing,
is yet, but I'm going to find it.
We are buying something, bro. We're closing. We just signed an 80-unit deal. I mean, like, let's enjoy that one for a few minutes before we move on to the next one. That's all I'm saying. Is like, you know what I mean, Mr. Deal Junkie over there.
No,
We got
it's
on the
like I
contract.
said, Gino. It sounds like a whole new world, and I'm ready to learn.
the only thing that I would caution against is that, look, when Buy Then Build came out in 2018, I thought people were going to think I was crazy. Okay. And at the risk of sounding like I'm bragging, if I log into any social media, platform, I'm getting hit with all these people that are like trying to teach me how to buy a business. It's become a popular topic, okay, in entrepreneurship, and that's awesome. But
because school sucks and they don't teach you how to do it in school.
But the thing is that I've always been very hesitant to throw clickbait out there. And there's a lot of people that
You're not sitting on a Lambo with gold teeth telling like people how to do it. I could see Walker. I could see you doing that, man. It might work.
I mean,
10% down, yo. Let's do this.
I mean, I have a Tesla. I guess I could like be in my garage with my Tesla. But it's one of these people that are better at marketing than me. I'm better at buying companies and running companies and selling companies. And there's other people that are better at social media marketing. And they really have capitalized on, look, let me teach you how to buy a business with no money down. I could name them, right? But I'm not going to. But the point is that, like, if your whole business strategy, your whole acquisition strategy is, I'm going with no money in my pocket at all, and I am going to plan to put zero skin in the game, I just want to share with you the reality is, especially if you're a first-time buyer, that is so hard to do. It's sort of like saying that your career plan is to move to Hollywood and be an A-list actor. It happens, but like you can't have one person stand up and be like, I'm Brad Pitt, I moved out here from Missouri and look what happened, and like, so now I'm going to do it too. Like it's just not, statistics don't work that way, right? And so you need to have an ounce of realism with that. But Gino, to your point, if you are successful in getting that deal under exclusive, right? I mean, you can take down, I mean, I don't want to tease it, but you can take down a 20 to 50 to $75 million transaction with like $100,000 out of pocket if you know how to do it. Okay. And if you're trying to do it on your first time, just please don't. Please just go buy a smaller business.
Yeah. But learn how to be an operator, right? Go buy a business and figure it out before you tank a major acquisition. Like, guys, it's okay to take steps and put in the work, right? Everyone wants to go to 0 to 100 with the get there-itis, and that's where people fail.
That's right. So. And I mean, I've bought companies with no money out of pocket, and there's no way that I ever could have done it on my first deal, maybe even my second. You know what I mean? Yeah. It's like you guys. You can't your first multifamily can't be 120 million. It just can't be. It's not possible. Or is it, guys? Is it?
You'd have to partner with very experienced people, and you could be a cog in the wheel. But I don't see someone leading a $120 million acquisition on their first deal.
It's exactly the same in this world. If you've got an Ivy League MBA and you know the right people with in Cambridge or whatever, and you want to jump in, and you want to jump in with 10 or maybe 20% equity and like leverage all this whole machine and take businesses like that out. That's great. Go be an independent sponsor. But good luck with that. Yeah.
I think my favorite thing that you discussed was the core competency. I just want you to elaborate on that a little more and how people can identify their core competency. Because if you can really get dialed in on what your core competency is, to your point before, it's going to lead you to the promised land and where you should be inserting yourself in the organization. So any tips on how to identify that and then how to apply it?
I mean, what I would say to that, Jake, is number one, look at, because core competency is the business version of what do I bring to the table as an individual, right? And so look at your business and try to understand, like every time I'm buying a company or I'm running a company, I always think about like, what is the one metric that moves everything else, right? And I get it down to one metric. And the thing is that key business driver tends not to actually be the the core competency, which is weird. The core competency tends to be the activities that make that key metric function. Okay, so you might have a well, whatever, just like you might have people and organization core competency. You might have a sales or core competency. You might have a marketing core competency. You might have operational strength, right? I mean, it might be you've got some kind of DNA in your company that is going to be the thing that you do better than anything else. And I like to take that, and I am like the biggest fan of Jim Collins that has ever lived, and he's got that hedgehog concept, right? And it's like, what can I be the best in the world at? What drives my economic engine? And what am I passionate about? And when you overlap those three things for yourself, you can also overlap those three things for your business, and you can understand exactly what it is the activity that is your core competency. And as we talked about before, trying to find that business opportunity that aligns with that. Okay, that's the business you want to buy.
That's the sweet spot.
That's
the meat of the bat. Yeah.
And I mean, you can. I mean, I almost called the book "Buy Then Chill" because that's what people want to do. They want to buy and chill out, but they don't. You got to build it, right? I'm kidding.
Yeah.
But the point is like if you
well,
can.
It sounds good, but you're not the Lambo guy, so we got it.
If you can align that core competency with that opportunity, and it fits in with everything else that you're already doing, like your industry and all the rest of it, you're going to build tremendous value more rapidly than anyone else possibly can.
So the biggest risk I see in all this is the scale, right? You may have a core competency, but then you buy a business and then it needs to scale from there. You need to operate. Any tips or resources for people in that position that are getting into entrepreneurship to begin to scale and recognize the importance of that?
Okay. So
it could be a entire podcast in one question.
That's the problem. It's sort of like saying, like, tell me about real estate. And it's like, well, single family, multifamily, like fix and flip, or, there's a lot going on there. And so what I would say is just to overly simplify is if you've never run a company before, okay, and you're buying a business, the first thing you want to do is go find other entrepreneurs doing similar things. And I found that through Entrepreneurs Organization. Okay. EO was a great.
Did Gino and I need to join EO? Do you recommend EO?
I loved it. Oh my gosh. Yeah. No,
I was not in it anymore. That was past.
I was in it for about 5 years. I was on the board. I did all that stuff. And I'm not in it anymore, Jake, because I ended up buying too many companies and I couldn't make the meetings anymore.
I gotcha. That's a good problem to have.
Yeah. So I was scaling a little bit differently. And so, but again, that was wonderful. And then the other thing that I learned through there was sort of like the EOS, right? So Gino Wickman's entrepreneur operating system. I think that these are, look, am I being very generic with my answer? Yes. But these are also like the sort of go-to things in terms of like, hey, I have a very specific company that's very different from all of these companies. What are the things that I can get my hands around to figure out how to ramp up and scale up and leader up from there, right?
It's such an important component, though, and it was such a inflection point for us in our growth where we didn't really take it seriously and we didn't recognize it early on. And then when we leaned into the importance of it, things really started to take off in a great way. So I make it a point to always highlight the importance of scale and any tips or tricks that I can pick up from others, because so many people starting out as a solopreneur and they never get to that next level, and the pinch there, or the bottleneck, tends to be their inability to scale and create systems. So
well, and Jake, look, I know I'm super successful. I'm great looking. I mentioned I have a Tesla. Like, I'm an author. I've done all these things.
You are throwing off big time Cali vibes. I get it.
What I'm going to tell you, though, is
he's middle America, folks. He's actually right down the road from Bud Light. We're not going there, though, but, just saying.
But the point is that I've made so many mistakes and have had so many hard times and, like faced bankruptcy and just been in a tight spot just as much as any other entrepreneur, right? And so this isn't all rainbows and sunshine. And the point is that
definitely not. Yeah.
The biggest thing that I did wrong was buy a bunch of small companies in different industries and different geographic markets with different customer bases, like everything was different, right? And it was like I wanted to be like the smallest private equity firm that no one had ever heard of, but I was going to own all of it, right? And that turned out to be a complete disaster because I wasn't working in one vertical and I wasn't getting the sort of multiple expansion that comes from working in one space. And I wasn't
The
creating
synergies that we were alluding to before. Nice.
Yes. So I was having to build a horizontal team instead of a vertical team, I guess. And
Yes.
then I chose not to because I wanted all the money, right? And I wanted all that equity build up, and I wanted all. And so it was just like you go absolutely bonkers. You can't do it. You can't do it.
Advice. Yeah.
Yeah.
No, I love that.
So just chill out. Do one at a time. Everyone's like, Walker, I want to be like you. I want to own like 7 companies and all this. I'm like, buy one. Just buy one. And I know you're going to have a 3 to 5 year plan, but here's a secret. It's going to take you 7 to 10 anyway. Okay. Keep the 3 to 5. You might hit it. Right. But these things, they take a while. Entrepreneurship is a career decision.
Then, put it out there for 10 years and reverse engineer and show on your spreadsheet what 20% year over year growth looks like. Oh my God. And that can be the fuel to get you excited because, gang, it's powerful. You hit that 20% mark year over year, you're gangster. I'm telling you. Yeah.
Well, there's this other presentation I do where I show you, like, Jake, you and Gino were talking about potentially buying companies to expand your current business, right? So
with synergies,
right? So the assumption there, and please don't answer this.
That counts towards my 20% MFers, okay? By the way, that acquisition still counts as 20% growth. Count it.
Yeah, exactly. Of course it does. It's the fastest way to grow that. You can double, right? I mean, but the point is the assumption there is that you already have a business with existing earnings that satisfies Jake and Gino, okay? And when you go buy this existing company with maybe 10% down, okay, and 90% leverage, if you're not extracting earnings out of it, okay, and you're saying, look, we want to keep the earnings over here, and we want to build up the equity faster. If you buy something at like a 3.5 times, you can pay off the entire loan in about 3.5 years. Okay. And I mean, it is so rapid. It starts to get so fast once you're not draining it, right? As long as
because you don't need it. You're already good, right?
So then
let's play for, because we love playing for the long game. So I think that's great advice. Yeah.
You're already in a place of strength. So build safety in the acquisition, grow it, reinvest in it.
Put the moat around the business. I love it. So any books that you've read over the last year or so that would add value to the listeners?
Oh my God. Right now I'm reading a book called The Alter Ego Effect by Todd Herman, and it's something a little bit different than what I normally read, but it's really kind of eye-opening to me to learn about like how top athletes like sort of put on a mental. It's like top athletes, top entrepreneurs, speakers. Yeah, are you familiar with this book?
I literally was talking about it like a week ago with Gino about how there's people that I feel like lean in and create this persona, and then they become the persona.
Yeah. So alter ego effect is great. The innovators, the innovation stack by Jim McKelvey is one that I like. Buy then build sort of goes right, and Jim McKelvey kind of goes left. But it's sort of like we believe in the same core issue, right? And then it's just how do you solve it? And so I relished that book. And then the other one that's coming to mind is The Lifestyle Investor, Justin Donald. That was a recent read that I absolutely loved it. Now, he's all about just creating, cash flow investments. And so the thing is like when I think about, how do you get to, become an ultra high net worth individual? Step one is have a business. And if you don't have an idea, or you're stuck as a middle manager, or you can't get your startup going, buy one. Duh. There's $10 trillion in business value changing hands from baby boomers to this decade, like right now.
They're all going to die, folks, real soon.
It's literally like 45%.
And they hold the chips. They hold the chips. They have all the wealth, okay? The millennials don't have the money. The baby boomers do. They're about to die. Get your piece now.
It's ridiculous. I mean, it's like 45% of the U.S. economy is owned by baby boomers businesses, right? Yep. And so this huge transfer of wealth is happening. And so step one, get a business. Step two, build safety in that business. Step three, start investing that money with Jake and Gino into their multifamily properties.
We don't take money.
Going. Do you not? You don't syndicate?
We don't take money. No, we buy our own stuff. Yeah. We're little piglets.
Yeah. I can understand it. I understand it.
No, we did a couple back in the day. We just were like, we started buying our own stuff, and we were like, hey, let's test the syndication model, and we really just love owning our own assets.
Here's the deal.
Absolutely love it. Yeah.
And Jake, here's the thing: is like I have done this for almost 2 decades, right? I've like about 200 million has gone through my hands. Okay, I feel like I am so teed up to go out and just hit a private equity firm and be like, look, I'm gonna buy this $60 million company. I'm gonna run it as CEO. I'm gonna grow it at 20. Like, fine, they'd give me the money. I'd get, I'd get maybe 20% equity, all the rest of it, and it would be sort of like an accomplishment. But
yeah, dude,
I don't want to have to report to those people.
Yeah.
Right now, I own everything.
Yeah.
I mean, I've got some minority investors in a couple of my businesses, but I own everything, and just the freedom that comes.
Let me interject though. For those of you starting out, you may have to syndicate, and that's a good thing. It's a great tool.
Not hating on it, Gino, at all. I think it's great for many people. We just were fortunate enough to figure it out by bootstrapping it, and that's why it's become our. But I think it's a great model. I mean, people kill it. Yeah. So.
Well, and the business acquisition analogy to that would be like search funds. And if you're in an Ivy League MBA program and you want to buy a business with someone else's money and run it, I can imagine no better an initial step post MBA.
Yeah. It's a personal preference. I want to be clear on that. I love buying my own stuff. Syndications are also a great vehicle and a great way. And it's, to your point, the core competency. Is your core competency more in line with being a syndicator than an operator? If so, that's what I'm saying. And Gino, I appreciate you for calling me out, because it really is. It's a fantastic it's a fantastic way to grow your wealth. And if your core competency aligns with that more, there's multiple tools in the tool belt to do well in multifamily investing. And if that's one of them, by all means. If folks want to get started with you and the lab, what is the best way to make a step towards Walker?
Sure. I mean, we've got tons of free resources on Buy Then Build. There's a video series. There's a whole bunch of stuff you can get into. Obviously, Buy Then Build, Wall Street Journal bestseller, sold 70,000 copies. You can get an ebook for under $7. These are very approachable items. The AcquisitionLab, our goal there was to build kind of like the Y Combinator for business acquisition, right? Mm-hmm. Like world-class education, vetted community. When we started, we had a 12% acceptance rate that sort of crept up to about 25. Yeah. So about 75% of applicants don't get in, right? And it's not. I don't want that to scare anybody. Like we're not. It's not like
you can't take everybody. We're the same way, because if you bring in the wrong people, they're going to pollute the community, and people are going to do deals together in that community. You cannot be bringing in people that don't align with your values. I completely agree.
That's right. So, and then we've got about 11 coaches, basically on staff, and so and the vetted community. So it's that's been the goal. That's at acquisitionlab.com or buythenbuild.com.
Yeah, I'm going to ask this. I already know the answer, but this is the best podcast you've ever been on, right? Like hands down.
Oh yeah, I mean without question. Without question. Yeah.
I just want to confirm that.
I mean, you guys you're knowledgeable, you're approachable, you're confident, but like I also don't feel ganged up on. And Gino's shirt is like inspiring, and I mean it's one thing after another on this podcast. I love it.
For the folks not on YouTube, Gino's throwing his hands up, giving me this look. So Gino, it's all you. Take it home, baby. I'm kicking my feet up. I'm out.
Just before I wrap everything up, I want to go through Walker's story. I think the first thing that you guys mentioned, it's culture and community over commissions. I forgot who said that. Someone on this podcast said that. And that's what Walker's building. He wants culture, he wants community. He's not going to actually be a sellout. And I think that's what we try to aspire to at the Jake and Gino community. And for those of you out there that drink Starbucks, skip the Starbucks, buy the book, and then you got your $7. And I'm sure this is worth a lot more than $7.
Buy then build.
Don't even like, it's not even an issue. Go on there and buy the damn book. You know what I'm saying? There's just so many different strategies, so many different techniques in there. And from 2004, then Walker goes to college, graduates from the Sloan Business School, and multiple attempts. He didn't talk about his scars. I see some scars on his face. He got beat up a little bit. I know. I like to think big, to start small. That's such a great idea, everybody. You think big. Think about those 100 units. But it's okay to buy a 12 unit, because the next deal is not going to be 12. It's going to be 15 units. I love the idea of how to buy the business. I have to read these out for you. Growth and earnings, opportunities, business risks, documentation, and transferability. And that is really, really important. Go back and listen to that when you're buying a business. You know, the Tesla guy, the self-proclaimed model, I just want to thank him for being on the show, because it's been an awesome show. And I really enjoy it. I knew this was going to be a home run of a show because he's got a lot of knowledge. And what I like about it, he's got a little bit of small giants in him, Jake. I mean, he's not out there trying to become the biggest private equity. He understands what he loves to do, and he's just buying businesses and trying to create wealth. And through the acquisition labs, he's creating impact through the acquisition labs as well. So he's giving back. That's his portion of giving back. He doesn't have to do that. He can continue to buy businesses and not worry about, hey, Walker, can you get on a call with me today? I want to pick your brain. How many times have people called you and done that? That's painful. But at the same time, he knows at the end of the day, that creates wealth and that creates impact. And that's
Gino, can you say that again?
Hey, Walker, can I just pick your brain for 2 minutes? Just 2 minutes. Let's go for a cup of coffee at Starbucks. Buy the damn book. Go to Acquisition Lab.
Has anyone ever hit you up online asking to pick your brain? He's a very approachable guy, and I'm talking about Gino. Walker, this has been great. Really appreciate you.
It's so fun.
Gang, as always, we believe in buying deals for the long term. Think in decades. I'm Jake. He's the G Daddy, and that's Walker. We'll see you next time. Thanks, guys.